Hey, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial opinions, and make your own financial decisions. Today is Wednesday, April 27th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL 007, and we are going to start a new series here on Blockhead Traders. We are going to start talking about retirement. And while we are both a little ways away from retirement, you'll see why we're going to start talking about retirement here in just a bit. But before we hop to that content, I want to give a shout out to our Discord, link in the description below. You can hop in there. It's open to anyone. You can chat with Viper, myself, a few of the other Blockhead traders. Additionally, in that description below, you will find a link to thetagang.com/sprocket888, where you can find each and every one of my trades that I post, the good, the bad, and the ugly. But let's hop to this week's content of retirement. Viper, you and I are both probably a good ways away from retirement. I'd like to think I'm closer than I probably really am. But one of the things that I kind of personally regret myself is not actually understanding the preparation for retirement and all of the different buzzwords and the different choices. And I thought, figure that out later. Someone else will help me with that later. And I never really started kind of buckling in and trying to figure it out until several years ago. And so I wanted to take a little bit here and step away from crypto, step away from trading, and start talking a little bit about retirement. And this is going to be pretty different for a Blockhead Traders discussion, because this really is investing. This is not trading. I know we've talked in the past on the differences of trading versus investing and things like that. This is definitely classified, in my opinion, as investing.
Yeah. Retirement probably is pretty far away, but, just one trade away from retiring. But yeah, no, definitely it is still most likely far enough away. And I mean, I've done some planning, not as much as I should, but I mean, I've definitely I've definitely exercised some of the things we're going to talk about tonight. And honestly, a big part of it, I thought I had a handle on it, because back in college, which was sad that it took until college that I was exposed to a couple terms that we're going to hear about tonight of traditional IRA versus Roth IRA. And I remember in college, there was just it wasn't even a financial course. It was just some financial class that I think that us resident assistants, it was an opportunity to take, and we needed it. I don't remember the exact circumstances, but we took it, and that was the first time I was explained the difference between the two and shown the math about starting early and compounding and just the power of compounding and risk tolerance and things like that, risk profile. And so going into the workplace, I thought I had it all figured out. I was like, sweet, I'm going to do this and crank this knob and everything's good to go. And I mean, that did get me off to a good start for sure, but there is just so much more to it. So hopefully can demystify some of that here.
Yeah, but before we really hop into this, I'll give the warning, the caveat. We're absolutely not financial professionals. We're not retirement advisors. I'm not a financial planner. I stayed at a Holiday Inn Express last night, but really, this is my understanding of the retirement world, and a lot of in this series that I'm going to use is my own real examples. So I'll just talk about why I do what I do. Doesn't mean you should do what I do. Doesn't mean I should do what I do, but I do. So we'll just go with that.
I mean, I feel like it's like we say in everything we talk about. So, I mean, nothing we talk about on this channel are we experts in. Everything we talk about is literally our understanding at this snapshot in time, and it's why we talk so much about the Discord, about the community, about engaging and interacting, because that's the point here, is to grow all of our collective understandings.
So retirement. We'll talk a little bit here, and kind of the thing that I want to call out the most is it's never too early to start thinking about it, start kind of planning for it. And in my opinion, no one is really going to come up to you and say, "Hey, buddy, what's your plan?" I read lots of news articles in the Wall Street Journal and other financial literature and things like that. And, a lot of Americans don't really have, enough in their bank accounts to live without a paycheck for more than a week, 2 weeks. And I think the financial preparations that the average person kind of goes through, I don't know that they're ever really thought about. I mean, I never really even considered them until I probably took my very first job. And the question, as I'm filling out all my new hire stuff on day one, is, oh, and how much are you going to contribute to your 401k? And I was like, what's that? Like, I mean, I kind of knew what it was, but it's not like I had thought about that moment before I looked at it on the paper. And the first thing I did was basically say, well, why would I'm not gonna, I'll put money in that later. So I started my first job, not contributing anything to my 401k. And we'll kind of talk about what that is. But really what we want to get across here is, it's never really too early to learn these things. And I really hope, and my goal here in going through this is to just get you thinking about it and get you Googling about some of the topics and just see what this stuff means to you. So first up, let's talk about what I would consider retirement vehicles. And so this whole episode, or this whole part one, is all going to be about what are the containers that you might use in retirement, the account types, right? You're going to hear phrases like IRA, 401k, Roth, traditional. What does all that mean? And so this episode is all about just talking about those terms and talking about those account types. And I pretty much picked three major retirement account types that the general population tends to utilize. And this is the individual contributor. Each one of these should fit into your situation in some way, shape, or form. And the first one, and all three of these are different account types, and they have slight variations. But the first one is an individual retirement account, or an IRA. This comes in basically two different flavors. It comes in what's known as a traditional IRA, and we'll talk about that in a minute, or a Roth IRA, and we'll talk about that in a minute. But an IRA is a container account for retirement funds for an individual. The next account type is what's known as a 401k. There's a lot of similarities between a 401k and an IRA. We'll get into those, but essentially the 401k will come in three flavors: a traditional 401k, a Roth 401k, or a solo 401k. And then the last type that individuals can kind of utilize would be known as a simplified employee pension. Now, this is more for the self-employed, and we'll get into some of those details a little bit on, but you might hear it referred to as a SEP IRA or an SEP IRA, and that's really what it stands for, Simplified Employee Pension. And it's just a different place to put money in for retirement. And as we talk about these are not always mutually exclusive. So you don't have to choose one and not choose another. You actually can choose, if they fit you, they actually can choose multiple ones here. So before we jump into the actual different account types, you'll notice there's two terms that appear in variations of two of these accounts, and that's traditional and Roth. So let's spend just a tiny little bit of time talking about the difference between traditional and Roth. And really, this is all about when you are taxed. And so when you hear the term Roth or when you hear the term traditional, doesn't matter what it's associated with, it kind of means the same thing. And in a traditional one, so when you hear the term traditional IRA, traditional 401k, it means that there are the contributions that you make are made tax free. So that means the money going in is not taxed. Okay. However, when you take money out, that money is taxed at that time. And so traditional just means no tax going in, taxed coming out. And one thing to note, typically traditional accounts have no income limits for contributions. So you could be a millionaire, a billionaire. There are no limits to your contribution just based on income. They might have other limitations, but it's not income limited. Now, the other type of account that you'll hear is known as a Roth. Now, the difference here is it's almost the complete opposite of the traditional. In a Roth, you put money in the account and you pay tax before you put the money in. However, when you pull the money out of the account in retirement, it is tax free. So you pay no income tax on your distributions or your withdrawals from a Roth account in retirement. The difference here is that some of these Roth accounts will have income limits. So if you have an income over a certain dollar amount, you may not be allowed to contribute to that account.
So what are some of the things that people, or at least you, think about when considering traditional versus Roth, specifically in the case of like an IRA, opening your own? You know, in the short term, it feels like, tax now, tax later, whatever. But, what are some of the strategies that go through your mind when considering what that means exactly?
Yeah. So, when I think about it, and what you really have to think about is, one, what do you think the tax situation is going to be like when you retire? And the reason you have to think about that, right, is if we happen to be in an extremely high tax environment now, and I had the theory that, hey, in retirement, taxes are going to be a whole lot lower, just because the government, or whatever reason, the tax rate would be lower, I might want to put in my contributions now tax free, because that puts more money into the account to let it grow. Now, in every retirement account, growth is free. So once you put money in, they grow tax free. You don't have to pay taxes on the growth in there or anything like that. If you pay tax on money before you deposit it, you're basically kind of just trimming your contribution a little bit. And so you get just a tiny little bit of less growth. Now, if you think that the environment when you retire is, oh my gosh, there's so much debt going on right now, there's no way taxes can possibly go down, taxes are going to go up, 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 and you think income tax is going to be higher in retirement, you might want your withdrawals in retirement to be tax-free, so you don't have to pay those taxes. And that's the difference here. Now, me personally, I can't predict the future. Maybe you guys can, and that's awesome.
Join the Discord if you can.
I can't. Yeah, let us know what's going to happen. So I view it as a balance. Okay, so I say, you know what? Let me try to build up both pools if possible, so that when retirement comes, based on the tax situation that I'm in, I can choose to pull from pool A or pool B. It gives you diversification options for your withdrawals and your distributions when you're in retirement.
So how should we think about, because when I think about retirement, what do tax brackets look like in retirement? As far as your tax rate, or now, your tax bracket is based on your income, but if your income's more fixed, or is it fixed and it's really just based on the rate you pull out of these accounts. Does that go into this equation at all?
Yeah, it absolutely does. And you're exactly right, or at least you're touching on the right parts in what you said there. And that is your income in retirement is based on, well, one, did you take a part-time job? If you do, that's an income. The other piece of your income is your withdrawals from your retirement accounts. So if you pull out, say $50,000 a year from your retirement account, that is considered $50,000 in income. So now keep in mind that when I say it's considered that income, it's only considered income if it comes out of we will tax this when you retire. Okay. So if you're in a Roth account and you pulled out $50,000, your income would be zero because none of that money coming out of the Roth contributes to your income. If you had a traditional and you pulled out $50,000, the government would say, well, you had an income of $50,000. And for those individuals that have an income of $50,000, your tax bracket is 12%. So you owe Uncle Sam 12% of that $50,000. So that's kind of where this balance that I talked about comes into play. Let's say that I think when I retire, I'm going to need $50,000 in income a year to live. So I might try to build up both my traditional account and a Roth account so that in retirement, I'm pulling $25,000 out of each. So when I go file my taxes to Uncle Sam, I got $50,000 to live off of, but I only report $25,000 in income, and maybe that is in an 8% tax bracket. So I pay Uncle Sam 8% of $25,000 versus the 12 or 15% of $50,000. And that's where this balancing kind of comes in. So the last point I'll make before we kind of slide on to talk about and one of the accounts is one of the common strategies, because Roth accounts, in particular Roth IRAs, are income limited. So basically, once your income passes a certain threshold, you're not allowed to contribute to the Roth IRA account. And so a lot of times when you're earlier on in maybe your working career, while you're under that threshold, you'll want to deposit money into a Roth account because it's possible at some day you won't be able to based on your annual income. And so that might be something to consider as far as when you deposit money into each one of these. So let's dive into probably the most common term, and that is a IRA of the traditional form. And remember, this is an individual retirement account, and I'm calling out on a lot of these slides what I call key characteristics. They're not pluses, they're not minuses, they're not pros, they're not cons, they just are what they are. And the reason I'm saying that is because to somebody's strategy, they might be a pro. To somebody else's strategy, they might be a con. It really is up to your individual situation and your strategy. A traditional IRA account is open to anyone. There's pretty much no limit here. You don't have to be employed. You don't have to have any certain income. Anybody over the age of 18 can go get an IRA account. Actually, even minors can get what's known as custodial IRAs. I actually happen to have opened some of these for my children, and they are same concept. They do have an annual contribution limit. So you cannot contribute more than $6,000 a year to an IRA. If you do, you just are not allowed to get that with any sort of tax advantage as far as money going in. Because remember, money going into a traditional IRA is not taxed. If you wanted to put money inside an IRA above that $6,000 contribution limit, you can, but you have to pay tax on that money. So then you're taxing in, and remember, money coming out of the traditional IRA is taxed again. So you're double taxed. So if you go over your contribution limit, your tax going in and your tax going out. So typically people stay at that $6,000 annual contribution limit. Now, all of these accounts do have some caveats for what they call catch up, or basically, if you're really close to retirement, they kind of bump up some of these limits. I'm not going to get into those. Google them if that's you. You can read into it. Like I mentioned, you don't have any prerequisites here, so you don't need to be employed. You can be self-employed. You can be unemployed. Anyone can have an IRA. And the other nice thing about IRAs is when I told you earlier that these are not mutually exclusive. So you can have an IRA account in addition to a 401k, in addition to a SEP. So everyone can have an IRA, and just because you have them doesn't mean you cannot participate in something else. So it's like an extra arrow in your quiver, an extra tool in your toolbox. They're there. So like I mentioned, it is traditional. So contributions are tax-free, withdrawals are taxed. So when you take money out, you're taxed at whatever income tax bracket you're in the year you make the withdrawal. And there are absolutely no income limits here. So if you make $50 million a year, you can still put in $6,000 a year to an IRA. If you make $5 a year, you could still put in $6,000 into that IRA if it was gifted or what have you. There's absolutely no bearing on income when it comes to this. The last point is there really is no limit to the investments that you can do. And we'll kind of pull some of this up later on. And this is a huge thing when I was learning about stuff. Is I thought all of these things are limited choices. Like you really can, there's only certain investment vehicles you can put in. There's only certain things you can do. In general, there are limitations to the risk that you can take on. So you can't do fancy trading like we do in our brokerage accounts here about, naked calls, naked puts. You're not allowed to trade like that. Everything has to be cash secured. But if you wanted to buy Tesla, you can buy Tesla. If you want to buy an ETF, you can buy an ETF. Essentially, to open an IRA account, you go to any brokerage and you say, I would like to open an IRA account, and pretty much any investment vehicle that's traded on the stock market is open to you to invest as part of that fund. All right, so much like the traditional IRA, the very next one that we're going to look at is basically the Roth IRA. And like I said, again, individual retirement account, a lot of the same things apply. There is a $6,000 annual contribution limit, just like the traditional IRA. Again, there's no dependency on employment. Contributions, you're not limited if you're participating in some other plan. The difference here is your contributions are taxed and your withdrawals are tax-free. And there is a limit that you cannot contribute to a Roth IRA if you are an individual that has an income over $144,000. So as long as you have an income under $144,000, you can contribute to a Roth IRA. There is a difference for married, single filers, all that. You can look it up. But in general, there is income limits to Roth IRA contributions. Just like traditional IRAs, same thing as far as investment options and stuff like that. It's up to the brokerage, but in general, you can trade any sort of stock, mutual fund, ETF, anything you can pick up on your broker, you can put in, trade in your, or invest in your IRA. So the next set of accounts that I'm going to touch on is what's known as a 401k. Now, this is something that is unique and available to people that work for an employer. So traditionally, the 401ks are offered by your employer. Once upon a time in America, employers used to offer employees pensions. And those pensions were like, hey, you work for us for X number of years, and we will guarantee you a salary that is some percentage of your cumulative wages for the rest of your life. Well, companies are like, wow, that can get expensive. So pensions started kind of phasing out. Additionally, there was, employees kind of were like, well, I don't know. How does this company make sure they can pay me forever? And so there was concern. I mean, there's rules around pensions. You have to have them well funded. They were audited. They had oversight. You had to have them super cash full. But it just over the years was a dying thing. I am unaware of really any company that still offers pensions today. When I entered the workforce, it was pretty rare to have a company with a pension. I happened to have one at my very first employer. They did do away with it while I was employed there, and they gave us options. Um, but the general replacement for pensions that is widespread everywhere is 401k. And essentially, a 401k is just a retirement account like an IRA. The only difference is there is a much higher annual contribution to it. And a lot of employers will match contributions to the 401k. So you deposit money and the employer will also deposit money. What your employer does really varies. Some employers deposit absolutely nothing. Some of those match some percentage of the funds. So you might get, hey, for every dollar you donate, the company will donate 50 cents into or contribute into that account. Some will make contributions even if you don't make any. So they'll say, hey, we'll take 1% of your salary and we're going to put that into your 401k every year. I don't really know very many that do that. And then the matching is usually what most companies will have to some level. And this is interesting because you can have this with a Roth. So there are actually, and we'll touch on it on the next one, there is a 401k that is a Roth, and you can actually have a 401k traditional and a 401k Roth. The annual contribution to your 401ks are $20,000, $500, and that is between both. So if you have a traditional 401k and a Roth 401k, you can't contribute, $41,000. It's $20,500 aggregate. Again, the traditional 401k, just like traditional before, it is tax-free going out. It is taxed as income coming out and retirement. So going in, tax-free, coming out, taxed. There are no income limits to your 401k, just the annual contribution limit. And one thing to note, when an employer makes a match, that does not count against your contribution limit. Your contribution limit is your contribution only. So if your employee has a dollar for dollar match, potentially you could be depositing $41,000 into your 401k. I don't know of any employer that matches that much, but their contributions don't count against your limit.
Yeah, and this is why if you don't know whether or not if you're in the position where you work for an employer and you don't know the 401k situation, definitely find it out as far as the match goes, because this match from employers for your 401k. This is the definition of free money. You should be saving for retirement anyways, and then whatever they're going to match, like Sprocket was just saying, doesn't count against you in any way. It just slides into your account, paired up with whatever the conditions are. And so the long-standing, advice that I always got and followed was, if there's a match, no matter what your situation is, at least try to maximize that match. So that way, you're getting more for your dollar, whatever those conditions are.
Yeah. As I mentioned, my very first job, when I signed up, I was like, 401k, I'm not doing that. I think it was probably within the first couple months of working there. My mentor at the job, we were talking about retirement or compensation, something like that. He was planning for his retirement, and he asked me, he says, so you're participating in the 401k, right? And I'm like, nah, that's cool, man. I'll do that later. He's like, no. You really should start that now. And this was kind of the first individual that really kind of poked me when it comes to that kind of stuff. And, he started explaining it to me, and he gave that exact same advice there. As he says, well, I'll tell you what, I get it. You're young, you're going to have a family. But if you really want to kind of build stuff, try to put at least as much in the 401k that the company will match. That particular company matched up to the first 6% of your income. And so he said, make at least 6% contribution each year, because the company was going to match that. And it's literally free money. It goes into that account and it grows for 20, 30 years. And if you don't have it, that's 20 or 30 years of growth that you miss out on.
Yeah.
And so if you actually make those contributions when you're younger and you never really get kind of accustomed to a salary without them, it's kind of like you never had it. The last thing I'll kind of mention about 401ks, and this is of particular note, is like Viper said, if your company has a 401k, go get information on it, because this is not like the brokerage account that I mentioned in an IRA. Typically, companies want to control the financial instruments that are used in that 401k. So they will typically have a 401k administrator. Fidelity might be one, Vanguard might be one, Merrill Lynch might be one, and that is a company that is in charge and partnered with the company you work for to provide 401k options. And they could be very narrow options, they could be very wide, but basically it's a very curated set of instruments that you can choose to put your money in. And the way that typically works is you say, oh, I'm going to make contributions of X% of all of my paychecks, and I want, 5% of my contributions to go to instrument X, maybe 20% to instrument Y. The key point is the instruments that are available are heavily dependent on who is the administrator of the 401k. So moving on to the next account type, just like an IRA, there is a Roth equivalent of 401k. Exact same situation that I mentioned in the IRA world. The real difference is the Roth 401k, you are taxed going in, tax-free coming out. The other difference is not every employer offers both a traditional and a Roth 401k. The Roth 401k option is a little more rare that an employer will offer it as part of their 401k offering. It can be mixed with a traditional 401k if the company offers it. And just like I mentioned last time, that is an aggregate contribution limit of $20,500. One very important distinction is there is no income limit to this Roth. So that's kind of cool, because even if you get into a company where your income or your job might exceed that Roth IRA contribution limit, in the 401k Roth, that does not exist. So if you happen to have an employer with a 401k, definitely look into this to see if they offer a Roth version, because it might be a way to get some of that balance between accounts in retirement, between tax and tax-free distributions.
Yeah. And I am fortunate enough, it only was within the last 3 or 4 years, I think, that my companies did start offering traditional and Roth 401k in parallel. And the match, I believe, is aggregate between both. And so I can't like double dip on the match for both of them. But I remember when they started it, because I was like, oh, wow, that's cool. Like, I knew the concepts of traditional versus Roth. So I initially took whatever I had been contributing to the traditional and just immediately switched all of that to Roth to try to build that up a little bit. And this is just my personal strategy that, we'll see, because I wanted to do a little bit of catch up of that to now where I basically split kind of 50-50. Whatever I'm going to contribute to retirement, I'll kind of split it, half and half into traditional and Roth to try to keep both of them going. But that was surprised me that it was an option. I didn't even realize it was a thing that you could have a Roth 401k. So if you happen to be in that case, definitely leverage that to your advantage.
Now, if you're following along here, you're probably thinking to yourself, man, what is this? Why are these people that have jobs a little bit advantaged when it comes to contributions to retirement account? Why can these guys contribute $20,500 because they have an employer and I don't, so I'm limited to only an IRA of $6,000? If you're catching on, they're not mutually exclusive. So actually the people that have the employer 401k are basically $26,500 that they can put every year into a retirement account. Well, don't worry. There still is a 401k option for the self-employed, and that is known as a solo 401k. So this is specifically existing for the self-employed. You cannot have employees. You can read into it. There is a provision that does allow your spouse to be part of an employee and not be counted as an employee when it comes to this. So if you and your spouse have a business, a solo 401k might very well be an option for you. This is very similar to the traditional 401k. I am actually unaware of a Roth equivalent of this. So the solo 401k pretty much only comes in a traditional form where the money going in is not taxed and the money coming out is taxed. And it has an annual contribution limit of $61,000. So that is higher than the 401ks of someone who works for a company. However, the way that they arrive at that value of 61,000 is a contribution of individual payment of 20,500. So same as myself and Viper and our companies. In a self-employment, if you pay yourself a salary type of what's considered part of your contribution, same limit. Now, a solo 401k adds an additional element that they call a profit sharing contribution, which is the value of the business, like a one-time check that can be added on to bring it up to a total of 61,000 annual contribution. There's a lot of details around that. I'm not going to get into it. Go read about it if this applies to you. Key point here is this is an option that kind of levels the playing field for those people that are individually employed or self-employed. So one note, though, is a solo 401k, once it has at least $250,000 in it, for a total value, not contributions, but growth and everything, you are required to file annual paperwork with the IRS about the solo 401k. So look into it. That is another characteristic that it does require annual filing once the account gets large enough. And the last investment vehicle that I'm going to talk on here is known as a simplified employee pension. So this is extremely similar to that solo 401k that I just talked about. The difference here is you can have employees. So not very many, you can have a few employees. But if you do, then you can do a simplified employee pension for yourself as well as your employees. Has similar things as the solo 401k. It is a 61,000 annual contribution limit. That is made up of the lesser of 25% of your compensation or 25% of net self-employment earnings. This is also only a traditional flavor. So money going in, tax-free, money coming out is taxed. The difference here is there is no annual filings with the IRS for a SEP. So you could have $500,000, $1 million, and there's no annual filings with the IRS like that solo 401k, which would have an annual filing. So the last thing that we're going to talk about, and this is really say, well, okay, that's a lot of terms. Maybe you understand them a little bit more, but what does that mean for me? And I don't know what it means for you, but I will share what it means for me and what I have for my retirement or my strategy. So these are the vehicles that I currently invest in, that I currently have. in planning for my retirement. The first thing I have is I do have a traditional IRA. I currently hold that at the brokerage of TD Ameritrade. This is the same brokerage I use for all of my Blockhead traders trading activity, but I also have my IRA there. It is made up of annual contributions and past companies that I have worked for. I have taken my 401ks for those companies and I have rolled them into this IRA. It's something we didn't really talk about, but when you have a 401k and you leave your employer, that money that you have is yours. It's yours to keep. It can stay there in that company to eternity. You don't necessarily have to roll it. You just can't contribute anything else to it because you don't work for that company anymore. So a lot of what people do when they leave a company is they take those 401ks and they roll them either to their new company's 401k or they roll it most of the time to their own IRA. And so as long as the account is the same tax advantage, so for example, traditional 401k, you can roll it absolutely fine to a traditional IRA. You can't go from a traditional to a Roth. You're not allowed to do that. But that is what is in my IRA. I make annual contributions, and it also has the balance of past employers that I've rolled once I've left those employers. I also have my current employer also offers a traditional 401k. This is offered through Vanguard. I also participate in this. My company does a current match. It's not very large, but I definitely take advantage of that match as it is free money. Now, the very last account that I have, and we didn't really talk about this as some of the other retirement accounts because you could argue that, well, that's not really a retirement account because you can use it now. I'm going to talk a little bit about it because I view this as one of the retirement plannings that I'm doing, and that is a health savings account. And a health savings account, also known as an HSA, think of it exactly like all these other accounts I talked about for 401k, IRA. It is a container which will hold money. You can invest money, grow money, and you can withdraw it. And the difference is it's only for qualified medical expenses, which basically means eye doctor, general practitioner, hospital bill, vision, any sort of medical expense. That's what it has to be spent on. The thing with HSAs are they are what's known as triple tax advantaged. This is extremely rare, but there is no tax going in. The money grows and is not taxed. And as long as you take money out for a medical expense, there is no tax on the money coming out. It is completely 100% tax-free from in to growth to out. This is huge, in my opinion, when it comes to retirement, because think about everybody that you know. The majority of people's medical expenses occur when they're in retirement. So putting money into an HSA now, you might not use the money now, but it doesn't go anywhere. It stays with you forevermore. And maybe something will happen and you need it. Maybe you just keep building and building and building. And when you get into retirement, and the great thing here is going back to that Roth IRA versus traditional IRA, $50,000. You need $50,000 to live. So you take 25 out of traditional, 25 out of Roth. Well, let's say of those $50,000, 10,000 is made up of medical expenses. So throw in your HSA, and now you pull out $10,000 from the HSA, you're left with 40,000, and you split that between your traditional and your Roth. And now Uncle Sam sees an income on your part of just $20,000. So this is where I believe an HSA really is part of a retirement strategy, even though you can benefit from it today. So you have eye doctor appointment, you have medical expense right now, next week, next month, you can use your HSA to pay those bills tax free, or you can keep the money in there and grow it into retirement.
Yeah, and the HSA is something that I've certainly utilized a lot, just as part of our family health plan for various surgeries and things like that. But um, you know, once I started to realize just how much of a, I guess I use the word traditional carefully, but how much of like a traditional retirement account this was, the more I was like, oh, like that makes a big difference. Like initially I was like, well, let me calculate like the difference between my deductible and when coverage kicks in, and let me just make sure that the HSA has enough to cover that gap. So then I don't have to worry about out-of-pocket expenses. But there is a cap on what you can contribute to your HSA per year. And what I started to then think through was that longer term potential for this account, to where I just max it out of like, no, I don't care about that gap. Like, I mean, well, I care about that gap, but cover it. And then over time, as the surplus accumulates, you can invest in this thing. Like, so you can, similar to like Sprocket was saying on other accounts. I mean, I don't think you can get into options or naked puts or margin or anything like that, but just buying an ETF, something like that, you can do that in here. So now I'm at the point where I have enough surplus where I always keep the gap available because I need that cash secured to be able to use that. But then any of that surplus, then I go into investment mode with it and now let that start growing over time, to really maximize the utility of all the different future cases that this account can serve.
Yeah, definitely. It was kind of weird when I first got exposed to an HSA. I think I just got off on the wrong foot with the HSA because when the employer I happened to be working for had one of the most Cadillac health plans ever. We did not pay a dime for it, and they had 100% coverage on just about every sort of medical procedure that you could come across. So, for example, my first daughter went in, and she was born with a cesarean. So you get an extended hospital stay as part of that. That employer's plan that I was with at the time cost me nothing. They had a $25 copay for a specialist and a $10 copay for a doctor. So that entire hospital visit, birth of a child, it was like a 3 to 5 day stay at the hospital, cost my family $25 because for the cesarean, you had to have an anesthesiologist, and that was the specialist. That was the specialist kind of copay. That was it. And when that employer started kind of clawing back some of the medical benefits, as most companies did over the years, that you then started getting higher you got deductibles, you got cost sharing, you got limitations. Well, they eventually got to the point where they're like, okay, well, now we're going to charge you monthly for your coverage, and we're really going to reduce the benefits, but we're going to give you an HSA. And I was like, what? This is garbage. This is crap. What, we're taking away the stuff we used to have. And I just didn't participate in it. I don't know if I was just pouting or what have you. And then when I started looking into it later in life, I was like, whoa, actually, I really should have been participating in this longer. And then I started participating and contributing. And for a long time, I thought your employer had to offer you the HSA. Not true. So you can open up an HSA yourself. You don't need an employer to offer an HSA. So just that was something I learned later when I had switched employers, and I was like, well, do you have an HSA? And they're like, well, yeah, we do. But you don't really need us to provide you an HSA. You can go open your own HSA and contribute it to it. I mean, we do matching. So this employer I'm with now does matching to some degree to HSA, kind of like the 401k. But yeah, you can get an HSA from from a brokerage today.
Yeah. The only thing I would say to double check what I'm about to say is if your employer does offer an FSA and you are participating in that, I do not believe you're allowed to open an HSA. You're not allowed to have both of them. But double check on that. The primary difference is the FSA is not a long-term plan. That's a use it or lose it within the year kind of plan. And so some companies will offer that. It is tax advantaged. It does give you some of that flexibility, but it is very short-term limited. And I believe as part of that, you can't have both of them. If you decline the FSA, then I believe you could go open your own HSA, but that's all part of the do some due diligence to research that if that applies to you.
Yeah, I didn't touch in on the FSA, which is a flexible spending account, I believe is what it stands for. It has a lot more strings attached, let's call it. It didn't fit my personal strategy, so this is about what I do, and I don't know much about that. So look it up, but I think you're correct, Viper, actually. So the one thing I do want to just kind of screen share here a little bit with you, because, I talked about, well, you can open these at a brokerage. And so what I got here, you've seen this screen before on Blockhead Traders. This is my brokerage account with TD Ameritrade, and they happen to be my broker that I use for everything. And the cool thing here is in this exact platform, I can come up here to kind of my account drop down, and I can go down and say, I want to go trade in my IRA. And I just click that account. All of my investments switch over to what's in my IRA account. You can use this in the IRA. You can trade in the IRA. You can make your plans. You can make your trades. And if I'm like, oh, you know what? I want to change some things in my HSA. I just drop down, click the HSA, boom, I'm in my HSA account and I'm making my trades. And so there's a lot to be said to have all this stuff in kind of one area, one shop. The same tickers that I buy for my brokerage account, I might use in my IRA account or my HSA account.
Yeah, and that's, I mean, it's a nice convenience to have, because I have accounts. I have some rollover IRAs, which I guess technically I could move, but I just, I don't know, don't disturb, don't kick the hornet's nest, I guess. But I have accounts spread out, and so therefore those ones that are not like in TD Ameritrade, since obviously I'm in there a lot more, I don't do as much active investing or trading in there, which could be fine. And that's sometimes some of the buffer of my own style, but I kind of set those to a longer term ETF, something that is more managed by the custodian that it's through. But it would be nice to be able to just flip between them, make a play, across them or whatever. But sometimes you don't have a choice. Sometimes you do, and you're just too afraid to move the money.
So actually, you bring this up. Maybe you know this, maybe you don't. I'll throw it out there because some of you watching this might not know this. I was really hesitant for a long time to move my money from my previous employer's 401k into something else, because I thought, oh, I don't want to sell all the investments. What if some of them are losing right now? What if I don't want to disturb it? I don't want to touch it. Kind of what you said. Then I learned something. So in the world of brokerages, switching accounts is relatively common. There is an entire system. So when you go to roll over an account from a 401k to a brokerage account, guess what they do? They don't sell out your investments and deposit the cash to have you reallocate it. They literally transfer the holdings as they are. So it takes a day. There's a whole system that it goes through. But if whatever shares you had in your 401k provider, they lift them, they shift them, and they set them down in your new provider. So when I went to roll that over, my portfolio looked identical to the portfolio that I had in my 401k. It just happened to sit in TD Ameritrade at that point.
That would be ideal. I honestly don't entirely remember. So my former employer, where this came from, it was not a 401k. It was some IRA, something. I don't think it was a straight IRA, but I think there was some other account types where it was, retirement-ish. And I do believe it was just brought over as cash. I mean, this was like 2 years into my professional career. I barely knew enough, to be contributing to these. I do know that there was a traditional and a Roth variant that I was contributing to. But I remember I got a job at the new place, and I got on. It was managed by Fidelity, I think. I got on chat or with support and was like, I got this old thing. I don't think anything's happening now because it was managed by the old company, and so that they you leave and they say, we're not managing this account anymore. It's still yours, but we're not providing services. And so I still don't know exactly what happened, but I know that the support person was like, well, yeah, we can roll that over. And he did magic things to me at the time. And all of a sudden the money came over and it was available in the Fidelity platform as an equivalent account. And so then I just started toying with it there. But I do think mine was, in hindsight, it was probably settled cash that was then transferred over.
Yeah, so that is a possibility if that 401k didn't work or operate in traded funds on a exchange. Yeah. So sometimes those brokerages or those 401k providers, they'll make their own custom products for that particular employer. And in those cases, they can't transfer that product because it's custom only to that world. And so those would have to settle to cash. But in my case, the 401k was just a narrow set of public ETFs, mutual funds, things like that. And so those existed on the same marketplace, the open market. And so they were able to be lifted and shifted. But if there was some custom thing that wasn't traded on a public exchange, I could see that needing to settle to cash. So that brings us to the end of this week's episode. This really was just an introduction into accounts and terms. We're going to get into additional phases of the retirement. How do you select investment instruments? How do you balance them? What are you doing? And basically, I'll use myself as the guinea pig. I'll use myself as the demo. I'll tell you what I do, how I do it. And that's what the subsequent episodes will kind of start touching on. If you have a question about something, you're like, man, I really would love to know this aspect about planning for retirement. Drop us a note in the description below. Hop into our Discord. Let us know what you're thinking. This is, like I said, a little bit different of approach for us. So, if you're like, dude, stop talking about retirement, just get back to the crypto and the trading, we welcome that feedback too. This is a world that I'm learning myself, so I don't have all the answers, but I would love to dig into them to find them. It has been a crazy, volatile week out there in the actual equities world. I hope you guys are all finding the pockets of green that do exist here and there. They're kind of hiding. They're a little bit hard to find right now, but they are there. So good luck out there this week. Happy trading, and remember, think outside the block.